Hey, today we're here with John Burnham of CrossCountry Mortgage, and we're going to talk about the questions that buyers have most often as it relates to a mortgage lender. So, hi, John.
How you doing?
It's great to have you. And so as we go through these questions, feel free to expand on them however you think it sees fit. And we'll just get started. If you could address like first-time home buyers, like what kind of products benefit them, and then maybe most importantly, like upfront, like what myths there are about first-time home buyers.
You bet. One of the probably most common questions we get for our first-time buyers is what programs are out there, what maybe incentives are out there, different interest rate benefits, closing cost incentives. So there's quite a few. To tell you, there's probably at least a handful, maybe even up to 10 different programs that really specifically target first-time buyers. The biggest thing that I try to convey to my first-time buyers is just because you're a first-time buyer doesn't necessarily mean there is a specific benefit for you, because a lot of them are income driven or geography based. And so where you're buying matters, what your annual household income is actually matters too. So depending on a certain income category or what we call targeted areas, which is based on a certain geography, you could have quite a few really good incentives. There's programs that offer up to maybe $5,000 to $10,000 towards closing costs. There are interest rate incentives. You can do conventional loans. You can do FHA loans, which we'll talk about a little bit. Some of the rate differences.
So geography, like that's kind of interesting to me. Would that be like neighborhood by neighborhood, or?
It is.
Wow. Okay.
Yes. Yes. And so depending on where the property is located, and this is something that in the pre-approval process we can uncover. Hey, what areas are you looking in? Well, we like these 2 or 3 different neighborhoods. Okay, well maybe one of those neighborhoods specifically has a first-time buyer benefit, and it's considered a targeted area. It might shift the focus of where that buyer is actually looking, and help also narrow down the real estate agent search because hey, this particular neighborhood has a really good incentive right now. And so that could really help bring their closing costs down, bring their interest rates down. So it's a really good idea to look at.
Yeah, that's cool. Any specific like programs that are like really, really popular right now, or?
Yeah, so a couple of the common like down payment assistance programs that we do. I think when some of my first time buyers, when they're thinking I'm a first time buyer, they're thinking there's an incentive for them, and a lot of times there are. And typically that incentive is a down payment assistance piece of the puzzle, right? So if when my first time buyers come in and they actually have their down payment already, then you can pivot away from a down payment assistance program and focus more on the geography, because then it does matter, maybe where they're buying, and they could get an interest rate incentive versus a down payment incentive, right? And so that's something that we look at closely. But specifically, the programs right now that are probably most popular, there's one called TSAHC, which is the Texas State Affordable Housing Corporation. That's a 501c3 nonprofit, so it's not a state agency like the other one, big long acronym, which is TDHCA, which is Texas Department of Housing and Community Affairs. And that one is more of a state agency, and they have interest rate incentives, they have closing cost incentives, and again, you've got to qualify for it. So one of the things, also a misconception, is a first-time buyer in the mortgage world is someone who has not owned a property in the last 36 months. So if you owned a property 5 or 10 years ago, you're actually a first-time buyer as far as our program's concerned. So you still have to fit into maybe those income levels and the different category, of sort of program-focused benefits. And a lot of our buyers may or may not, fit into those, but we'll navigate through those options.
So I think like the reason for getting an expert like John is you may hear about programs and be like, oh, that's a down payment assistance program. That's going to be the best way for me to go. And you might get it locked in your mind and get further down the road. Well, then when they come talk to you, you might be able to say, well, there's a neighborhood specific that makes it actually a better deal for you than that down payment assistance.
That's right.
So everything is individualized.
Yeah, we have to, exactly. Everything really is custom to the buyer, to the individual. One of the best stories I have for that is I had a client, a single lady, she was purchasing a home about 1.5 years ago, and she had saved money for a down payment. So she had actually a pretty good chunk saved. And she was asking about the down payment assistance programs. I said, well, let's explore it, because typically if you have your own down payment, the terms of the loan are generally speaking better than if you get the down payment assistance. But when we crunch the numbers, it actually made sense for her to hang on to her cash, take the down payment assistance, even though the interest rate was a little higher and the payment was there for a little higher, but she got to hang on to her cash.
Right.
And depending on the program, for her, there was a 3-year prepayment penalty essentially on that down payment assistance. So she needs to keep the loan for 36 months, but she said, I'm going to be in this house for 4 or 5 years plus. And so it just made sense to do the down payment. So we never prejudge like, oh, this is the best program or that's the best program without having all the information. So having all the info really allows us to navigate the different programs.
Yeah. So, I mean, it pays to not get locked in on something in particular before they come and talk to somebody that can help them for sure. And then I get people tell me all the time that their most important thing is cash preservation. So that's another good example of a way that maybe a program that they were thinking of wasn't going to help them out with that too. So
really important question for us to ask. We're really focused on payment and cash to close, right? Payment and cash to close. I think those two things, I like to call it the 2 checks that you're going to write. You're going to write a check every month for your mortgage, and you're going to write a check at closing for something, and it might be minimal or it might be a pretty big check depending on if you're putting a lot of money down or what have you. So really focusing on those 2 things helps us reverse engineer some cases the best program.
Makes sense. So I guess another question that people ask a lot are, what's the difference in the main loan types that people get? So like your FHA, your conventional, what's the difference between those?
Yeah, there's kind of 4 main ones. I can throw jumbos in there too, but the 4 main types are conventional, FHA, USDA, and VA. And so, of course, working backwards, our VA loans are for our eligible veterans or active duty military, honorably discharged. And those typically are 100% financing loans. So 0 down payment. We were talking off camera. There's still some closing costs perhaps that comes with those loans. So it may be 0 down, but there may not be 0 cost per se.
I was telling you that story of my friend. So there are closing costs for both sides always, right?
That's right.
But perhaps depending on the market and the home and the purchase price and all that, there may be opportunity for me to negotiate the seller to pay for those closing costs, but a buyer is always going to have something.
That's right. There are appraisal fees, there are insurance costs, there are some title costs, and so but what we do is look at what is that total outflow going to be? What's that total number going to be? And then based on the buyer's budget, we work with our real estate professional to negotiate with the seller. And not all sellers are maybe in a position to help with closing costs, but we want to also find that middle ground where there's a seller that is willing to, and there's a property that fits for the buyer, and we can negotiate. So VA loans, we do a lot of VA loans for our veterans and active duty military. The other 100% option is maybe like a less common loan, but it's a USDA loan. And it literally is this United States Department of Agriculture, so like the ground beef, but it's designed for more rural properties in nature. But rural in our day and time now is not necessarily there's cows in your front yard. It can be just an outlying area, 5 minutes, 10 minutes from downtown Hutto, right? In the Austin area, it might be 10, 15 minutes, from some major highways, but it might be 3 minutes from the HEB, and it's considered rural,
Right.
So that's a really cool loan. It's 100% financing as well, so no down payment required. There are some credit score requirements, which we'll talk about. There are some income limits. So if you make too much money, then you're disqualified from that.
Well, that's fair.
And we look at total income, and there's some property requirements too. But it's a really cool program for buyers that may not have a down payment. And then the 2 more common ones I would say is FHA and conventional.
Right. Yeah, that's what most people know about.
And so conventional right now, the minimum down payment, which is a surprise to many, is actually 3% down. So you don't have to have 10 or 20% down to buy a house. You can buy it with 3% down on conventional.
Yeah, I think that's probably maybe the biggest myth that people have about mortgages altogether is that you have to have 20% down.
That's right.
And it's not the case.
You just don't have to. Yeah, and in fact, it's better in a lot of cases to hang on to your cash.
Right.
Put less down, leverage the appreciation of the property, and still have some reserves and have some cash in the bank.
Exactly.
So Well, we love looking at all those options, and certainly we do plenty of loans where our buyers put 20% down. Yes, but you just don't have to have that.
Right.
And so the FHA, the minimum down is 3.5%. So you have 3% for conventional, you have 3.5% for FHA.
Yep.
There's pros and cons to all of those programs, and credit score can drive which loan program we go. Cash available can drive which loan program we go. Income can drive it. So there's lots of variables there. But most often we're looking at conventional and FHA.
So are those like the main pros and cons? Because you're mentioning pros and cons to each one. Like, is there like a standard list of pros for one and cons, or?
So what I typically unpack for my buyers when we're looking at the numbers is your higher credit score borrowers. And when I say higher credit score, let's just use a 720 as maybe a tipping point, right?
Sure.
So over a 720 credit score might lean towards a conventional loan. And there's reasons for that because of the mortgage insurance. There's some insurance costs,
right.
Mortgage insurance for conventional loans if you're putting less than 20% down. And typically those costs are less the higher score you have, right? So it's risk-based, right?
But aren't there always mortgage insurance on FHA?
Yes.
Okay.
Yes. So there's always mortgage insurance on FHA. There's some optional insurance, and there's ways to get to sort of navigate that on conventional loans. There's
actually kind of variable.
Yeah. There's 5 different kinds of mortgage insurance. We won't get into the weeds on that. But there's a lot. So conventional, you sort of have these various options. FHA is more standard. So if you have a 620 credit score or a 720 credit score on FHA, you're pretty much getting the same loan.
Okay.
And so it's not credit score driven, which is why a lot of our clients that may have had a bump or two on their credit, a blemish or two, it might make more sense to go FHA because it's not credit score. Interest rate is not based on credit score versus on conventional loans, it's very highly based on credit score.
Right.
And so the higher the score, you want to get rewarded for that. More of our clients will go towards a conventional loan. And the other thing too, I'll say on that is we like to present the two options. I always say, let the math do the talking, right? So we kind of, present these options, and sometimes it's glaringly obvious based on the options. Oh, this is definitely the best option because it's the lowest payment. It's the lowest cash out of pocket, but sometimes it's very close.
Sure.
Maybe just $3 a month difference between the two programs. And so then you kind of flip a coin.
Okay. Yeah.
And there's different reasons. And one of the things that might play in is how long you're going to have the house. This is a 3-year house. This is a 5-year house. If it's a starter home and you're going to have a growing family, that may be a different financing strategy than if this is kind of your forever home.
Sure.
And so we like to we ask all those questions and really find out what our clients' goals are, ultimately. So you can help meet them on the real estate side, finding the right house. We can help them meet those goals, finding the right loan.
Right. Yeah. So oftentimes I'll get like pretty technical mortgage lender type questions that I really don't have the answer to, or I shouldn't have the answer to because it's not my profession, right? So I'd kind of refer those over. So we talked a bit about like credit score. How does credit score generally impact like those types of loans? Well, I guess we'll just stick to the main two.
You bet. Yeah. So there are some credit score requirements on the 4 types. The USDA loan has a very specific credit score minimum, which is a 620. But on VA, there's actually no minimum credit score requirement.
Really?
There's no, and we just closed one recently where the gentleman's credit score was below a 600, and he had some old stuff that was popping up from a few years ago. Yeah. But when you look at FHA and conventional specifically, typically the minimum credit score for FHA is going to be a 580.
Okay.
Now there are some exceptions to that. There are times where you can go below that, but for the purposes of our conversation, 580 is usually the minimum. Conventional is a pretty hard line at a 620. So, and when I talk about credit scores, as a mortgage lender, we pull all 3 bureaus, right? So Experian, Equifax, and TransUnion, and then we take the middle of the 3. So if you got one that's really high, one that's really low, we kind of throw those 2 out and we just focus on the middle value of the 3. And I'm very passionate about the credit side of our business, so I love looking at the report and figuring out where there may be some low-hanging fruit to raise the score. Sure. Because most of our clients, they may have a feel for where their credit is, but they don't really understand why their credit score is what it is.
Sure. I guess maybe a a quick aside that you can address is people will go on Credit Karma and they see, well, my score's 700 when
that's right.
And then when they get a mortgage credit pull, it's not.
It's different. Yeah. That's right. Could be a little higher, but typically we pull a lower score.
Right.
And the main reason for that is there are consumer scoring models out there. That nothing against Credit Karma. I think they provide an amazing service. They just have a different scoring model for their clients than the mortgage industry. And if you think about the mortgage industry, we're all basically selling our loans to the same place, like Fannie Mae on conventional, Freddie Mac. These are these giant entities that buy most of the mortgages. And then you have government loans that are purchased by Ginnie Mae. They're backed by the federal government. And so if we're trying to standardize the credit system for mortgage companies, you might have 1,000 different mortgage companies out there. The only way to standardize it is for us to use the same credit score algorithm across the entire industry. Well, that's not necessarily what Capital One CreditWise uses or Credit Karma. And again, those are valuable services.
Yeah, good tools.
Great tools. They're just not a mortgage score. And so we do field that question often. And what I usually say is, there's just variances to the scoring algorithms, the scoring models. And so understanding what really drives the scoring models is helpful. And it's eye-opening for a lot of our clients because they go, wow, I'm a 700 on Credit Karma, but you pulled a 670. Like, why is that? And so we just talk it through. Yeah. And there's some reasons, some technical reasons for that.
I remember, I think I took a credit class from you and one thing that I thought was crazy was wasn't there 37 credit models or something absurd like that? Like a ton of them, all used for different things. And then we narrow down in pretty narrow band for mortgages. So.
That's right. And so, and beyond the score, and because I always tell my clients, like, I do not, I hate to say the phrase, I don't care, but I don't care what your score is. Like, I don't mind what it is. I care why it is what it is, right? So we really unpack, like, why is the score where it is? And I think that's a big obstacle for a lot of folks to take that next step in a home buying process because they've had a credit blemish, they've had a credit event, they had a repossession, or they had a foreclosure, or they had a bankruptcy. It's like that's totally fine. Like, you can overcome all those things and still buy a home. Yeah. And so developing a pathway, developing a plan, understanding where you are in credit and why your credit score is where it is really important. Having someone that understands the credit scoring model and then put a plan together. Right. Hey, this is what you have to do. And we've got one right now that I'm helping get a credit card because he doesn't have a credit card. And, sorry, Dave Ramsey, but you need to have a credit card out there just to have one to check that box to navigate.
I remember we have a client in common that she had no credit. Right. Yeah, she had nothing. She had got a scholarship to go to college, so she didn't even have a student loan debt, no credit card, no nothing. Right. And that was almost a bigger problem than bad credit, almost. It is. I mean, it's certainly better to have no credit than bad credit. But yeah, it's an issue because we pull like an NA, not applicable as your score. It's essentially, there's no score. And so, of course, there's programs for that. But in this case, I always look at, you want to tip the scale. If you've had some bad credit, you want to be able to establish some good or reestablish some good so that scale tips. And the time heals credit. That's the other thing that I convey to my clients is time is really the only thing that naturally heals credit. The longer you are distanced from your derogatory, your late payments, your bad stuff, the better your score is organically going to be. But there are some steps you can take to remove erroneous information because there's a lot of errors on credit reports. We see it all the time. And so understanding what's on there, like, oh, I didn't know that collection. I paid that collection. I didn't know it was still on my credit. Yeah, it's still there. And so we can help coach our clients through that too. So you had mentioned some low hanging fruit on credit to give them a little boost. What are some the most common ones?
Most common one is utilization of your credit card. So let's say you have a client has a credit card with a limit of $1,000. Yeah. And it wouldn't take long in this, in these days to rack up $1,000 on a credit card, right? You go to dinner, you buy a tank of gas, you go to the grocery store, and all of a sudden you're halfway there. Yeah. So what we see, the low hanging fruit is when you look at the utilization or capacity of borrowing, this credit score system is built on percentage of utilization.
Yeah.
So you want to keep your utilization low at a percentage wise. So on $1,000 credit card, you really want to keep it under 30% of the limit,
right,
which is like a $300 balance. And again, this isn't, charging the card and paying it off in full, because I have that conversation a lot. Well, I pay my credit card off in full every month. That's amazing. Keep doing that.
Sure.
However, what time of the month are you paying that credit card off? Because if it reports with an $800 balance, then you pay the $800 balance. The utilization is 80%. So you look 80% maxed out, and that can rob you of some points. And so when we pull a credit report, it actually shows what the upside is of the score with a certain amount of funds that our borrower could use. And so if you're going to pay the $800 credit card off anyway, you might as well pay it at a certain time of the month to benefit you the most. And so that's the other reason of talking to our clients well before they're ready, so we can coach them through some of these just low-hanging fruit, because they may have a really great credit score, 720, 740, but what if it was a 780 or a 7 or an 800? Like, that could actually impact their terms.
Just better and better and better terms as we go.
And better.
So on that, what is the ideal time for somebody to engage before they want to be closed on their home?
Yeah, I think if you have a deadline, work with the client right now, and it's the fall of 2025, right? So they want their lease is up in spring of 2026. And they're about 6 months out. And when the real estate agent called me, he said, is it too early to have a conversation? I think 6 months is actually perfect.
Okay.
Because if you have any credit events that you need to tackle, or any, you're going to get a job, you're going to get a promotion, you're going to have some kind of event that's happening in the next, 2, 3, 4 months, it's nice to know that in advance. And so I would say 3 to 6 months is kind of a good window.
Okay.
But if you're a year out, that's still a great time to have a conversation with a mortgage professional. Have a conversation with your real estate professional.
Sure.
Like, I'm looking in these neighborhoods. What kind of trends are you seeing? Here's my family dynamic. Here's what we're looking for in a home. Because there are some really good opportunities when you plan ahead. And for a lot of our clients, unfortunately, they find the house first, and then they need to get the financing.
Sure.
And that's okay. There's nothing wrong with that. But you're kind of like, cart before the horse, and you want to be, a horse before the cart if you can. So, but I'd love to have a 90-day window. Would be great. But
there's no too early.
There's no too early.
To engage.
There's no too early.
Makes sense.
Yeah.
Because then all you're doing is just giving yourself more and more and more.
That's right.
Opportunity to fix or just stay the course.
That's right. Yeah, and if everything's great, credit's in good shape, income is where it needs to be, you've got your down payment set aside, or maybe it's a no down payment loan, but where you're going to closing costs or how you're going to get paid, then it's the fun part is going and looking at homes, right? So get the financing stuff out of the way, check that box, and then go look at neighborhoods and look at houses, because that's the fun part. I think.
Because then you've done all the hard work, and
that's right.
And now it's just, like you said, the fun stuff. So thinking about interest rates, I get every buyer client that I have at some point in the last few months has told me that they're just going to wait until interest rates change. So I have a couple questions, and maybe I'll just lay them all out there.
Sure.
You can rapid fire them away at me. But does it make sense to wait for a rate when there may be an opportunity for us to negotiate a better purchase price against that rate?
Sure.
And then I guess after that, maybe look into your crystal ball and see where you see rates being in 6 or 12 months. So
it's interesting, because I have this conversation obviously every day as well. And I had a client yesterday. We did a video call.
Yeah.
And this was what he said to me. This is actually a veteran. So we were doing a VA loan for him. He's never bought a house before. And he said, John, I feel urgency right now in this market to buy now, because the rates aren't as low as I think they're going. He believes, and I do too, that they will trickle down lower. When the lower rates hit, there's going to be more competition. There's going to be more buyers. And he said, I think prices are going to go up. And we already know there's a lot of stats that say we don't have enough houses right now.
Exactly.
Even though there's a lot of inventory, Austin proper, has, I think it was the number 2 ranked buyer's market in the country, second to Miami. I read an article a week or so ago. And so, such an interesting perspective from my buyer. He said, I feel urgency. I want to buy now. because the rates are not as low as I think they're going to go. Because once you own the home, when rates go down, you can always refinance, right? As long as your financial situation.
I'm sorry.
Yeah.
Just to quickly, a question came up that a buyer asked me, refi for veterans. I know that they generally have no cost refis, but is there a limit to the number of times they can do that?
No, you can do it unlimited number of times.
That's what I told him, and I felt I was right. But
it's another acronym. It's an interest rate reduction refinance loan, and ERL, as we say. There's 3 R's in there. Interest rate reduction refinance loan, and it's minimal closing costs. We don't need an appraisal. That's part of why the closing costs are lower. Is we don't need an appraisal. There's usually some title credits because they've done the loan recently. There's no origination fees unless they're choosing to buy the rate down. Right. The only caveat with those loans is you have to lower the interest rate at least 0.5%, which most likely you're gonna lower at least 0.5%. Yeah, that's why you'd be doing it. But there are some parameters. One thing I love about VA, the VAs, they absolutely 1,000% are looking out for the veteran. Yeah. They're not gonna. There's some governors in place. There's like some stopgaps in place to prevent predatory lending, from some institutions out there, and also saving, veterans from themselves. Sometimes they don't know how much their closing costs are, or they get kind of lured in by a lower rate, but they have all these closing costs that are rolling into the loan. So there's parameters that require a veteran to have at least a 3-year or less break even on those costs. So that's something else we'll talk about.
Yeah, that's cool. Mm-hmm. Sorry, I didn't want to derail you from where you were going with interest rates, but it came in my head. And
that perspective, I'm talking to my client yesterday, and it was refreshing to hear that perspective from a buyer, because that's really been our message for the last couple of years. Exactly. If you can afford the payment, you need to be buying a house right now, because the prices will go up as interest rates come down. And really, if interest rates stay flat, the prices will continue to go up over time just because of inflation. There's going to be an appreciation, maybe 2 to 4% appreciation. So we have a cost of waiting analysis that we do. And we look at what you're paying in rent, what the closing costs are, what your tax benefits of home ownership are going to be, what the appreciation rate's going to be. And we factor in that cost of waiting. And I think when a lot of our clients see that, they say, wow, I do need to buy as soon as I'm ready. It doesn't mean go out tomorrow and buy a house. Or let's start planning for the next 3, 6, 12 months and get yourself in position.
That's a good calculation to make. It sounds like a cost of waiting.
Absolutely.
Yeah, so that's a good one I might steal that from.
And so on the interest rate topic, and actually the Fed just lowered the short-term rate, and this is a common misconception, is that the Fed controls mortgage rates, which they don't. They control the short-term rates, which are tied to home equity loans, or tied to the prime rate, which is also tied to like auto loans and credit card interest rates and things like that. But the Fed is technically not tied to mortgage rates. What drives mortgage rates is the bond market. So as stocks and bonds are moving out there, stock market's obviously doing really well right now. The bond market's been doing really well. And inflation really drives the bond market. So the lower the inflation, the better the bond prices are, and the lower the yields. And so as inflation comes down, mortgage rates typically come down. Maybe not exact correlation, but they are somewhat in tandem. And so as we had that high inflation a few years ago, it obviously caused rates to spike, and then we've been seeing them gently come down gradually, which is also a good thing. Right. We don't want rates to fall off a cliff tomorrow. Like, we need them to kind of come down manageably and in a controlled manner. And so that's been good. And so the crystal ball kind of says, all right, if rates are going to continue to gradually come down, at some point there's a tipping point with buyers where the headline finally hits and they say, oh my gosh, did I miss my window? Now there's maybe a little bit of, not panic, but motivation, right? They're like, okay, I'm going to do this. And as more buyers come in, it creates competition and it creates a higher price environment.
Yeah, maybe a little FOMO.
Absolutely. The FOMO kicks in for sure.
Well, great. Yeah. So I know that there is like probably 10 or 12 more hours that we could sit here and go on. But I don't want to take up all of your day. So probably we'll circle back at some point and kind of catch up some more topics that we didn't cover today. I think that's super valuable and people can get a ton from it. And that's a pretty good takeaway. And I like the fact that you say don't disqualify yourself up front. But like I tell my clients all the time, I was like, I work with ERA real estate experts. So that's the expertise that I have is real estate. But I also have a team of people that I surround myself with that are also experts like you. And then I'm going to do more of these interviews with different vendors that I have that are experts in their field.
Absolutely.
So, and I can really quickly get you together with these people and like a 1 day amount of business day time, you could learn everything you need to know and either move forward or don't move forward.
Absolutely.
But at least you're informed. I think we'll call it done there. And I really appreciate you sitting down with me today.
Thank you.
Yeah.
Appreciate it. Talk to you soon.
Yeah. Talk to you soon. And remember, I always forget this, but if like and subscribe, those are the most important ones, right?
Absolutely.
All right. Thank you. Have a good day.
Care.